Now, it is capital intensive and labor intensive. So if done correctly, you're going to need a lot more money to do this, which is why we're at the advantage. However, though, drop shipping, since it is very saturated and it's very competitive, and from a logistics standpoint, you don't really get a lot of pricing power. Actually, you don't get any pricing power.
Welcome to the Cash Flow Chronicles. I'm your host, Jonny and the founder of Cattani Capital Group. For the last 2 years, I've been studying alternative assets and now help solve the problem of creating passive cash flow for creators, influencers, and busy professionals by bringing you 5 episodes a week of easy to understand education in the world of passive investing. What's up, guys? Welcome to another episode of the Cash Flow Chronicles. I'm your host, Jonny, and I'm joined today by Benjamin Cohen. Ben is a principal and capital raiser at SC Portfolios, focused on purchasing and scaling e-commerce stores for clients. Ben, welcome to the show.
Thanks, man. Thanks for having me.
Grateful to have you. Ben is a good friend, yet to meet in person, but I think at this point we've talked pretty much weekly since we met a couple months ago. And I will be jumping on board, and this will be a great podcast because we get to learn all about what it is we're going to be doing. But before we get to all that, you've done other things. So kind of take us back a little bit and give us kind of the short story of what led you where you're at now.
Yeah, so quick background. I come from the real estate private equity sector, kind of like most people from your audience and most of your investors. So I ran the acquisitions and capital markets department for QC Capital, which is a syndication real estate firm out of Charlotte, with Chris Salerno for about 2.5 years. Chris, great guy, learned a lot from him. We syndicated capital and we acquired institutional Class A multifamily deals around the Southeast, kind of like most of us. And it was great. So I oversaw the underwriting analysis and preliminary sub-market analysis, due diligence, helped raise debt capital. So I learned a lot over a short period of time. Chris, he gave me a shot. I broke into private equity at 21 years old. So I left when I was 24. And on the side, while I was working with Chris, I was helping start up this e-commerce management company with my partners. And it finally took off. So I decided to pursue this route because I see a lot of tailwinds, and it's been a fun ride. So I would say I started in private equity, learned a lot about commercial real estate. I underwrote thousands of deals in the last 2.5, 3 years, and now doing this full time. So this is that's how I got here so far.
Nice. So how did you discover this asset niche, this kind of sector?
So I realized it was March, excuse me, of 2022. So I started this with my partners in 2020 when I met my partner at a Jake and Gino conference in Tampa, and we met again in Orlando when I was still in college. But it was March of 2022 when I realized, okay, this is going to get serious, because that's when the Fed started raising rates, and I knew there was going to be a huge liquidity crunch, and there was going to have to be some sort of a draw out of liquidity into the system because we've been inflated for so long. And I realized immediately that cash flows are going to be squeezed pretty dramatically. And they have, as most people know, especially in the real estate sector, multifamily, industrial, especially what cap rates are doing. So I wanted to find a different vehicle that could generate hefty liquid cash flow distributions every month. And that's where this came into place. And I realized that month over month and year over year, if done correctly, I haven't seen anything that has generated the monthly returns that this does. And once I started seeing this consistently, because my business right now, we have 99 businesses under management. I started seeing trends that on average, you're making about $8,000 to $10,000 a month in cash flow take home for the client. And that's when I realized, okay, this is scalable. There's something here, and I wanted to grow this. So it was there was a lot of events that culminated into where I'm at right now, but I'd say March of 2022 was big hit for me when I realized, okay, this can be turned into like an asset class or a financial product.
I love that. That's awesome. And yeah, we've been breaking down P&Ls and kind of really getting into it, obviously doing a lot of due diligence. So let's jump into it. What I guess explain what it is you can do, obviously up to what you can explain, right?
Yep.
Just for the listeners, just so you know, these stores are owned by individual clients. So we can't go super in depth about some things because it's technically their business.
Right.
But obviously we can stay high level. So let's kind of break it down.
Yeah, so quick back of the napkin of what we do is we'll upfront some capital. So we'll put about 35 to 40,000 bucks into a business. We use probably Shopify is the main intermediary source that we use to launch a business. But anyone who's familiar with starting a website, Shopify, Wix, WooCommerce, WordPress, Squarespace, any intermediary platform where you can launch a website or a business online, that's where we upfront our capital first. So we put about 30 to 40, 50K into the business, right? About 15 goes into the website design for development, for optimization and convertibility. And the rest goes into testing different products and conducting a stress test and a sensitivity analysis, excuse me, to ensure that the product that's being sold on the store, on the digital storefront, is yielding a minimum return of ad spend. The minimum for us, the threshold is 8.2, meaning if you put $1 into ads, you're going to get $8.2 back in projected revenue for every dollar you spend, right? Once it's done that and the business is generating consistently $1,000 to $3,000 a day in gross revenue, like GPR, if you want to analogize it to real estate, every single day, for about as I've seen as low as 7 to 15 days, all the way up to 45 to 50 days. Once it's done that, then we'll sell and we'll dispose of the business. So we broker deal our own businesses to a client. So let's say Jonathan wanted to buy a business. We transfer over the ownership, the intellectual property, the assets, the cash, the revenue, and the URL and the domain to his LLC. And now we stay on after we've sold it to him as managing partner. So even though Jonathan's the new GP, I guess, and he has sole ownership and 100% equity into the business, we stay on and we manage everything from A to Z. So we're vertically integrated. We have 6 different departments that handle operations, supply chains, internal, external supply chain management, and we have a marketing agency in house that does ad campaigns and media buying. We have a software development department, all that stuff. So it's completely passive for the GP, which I haven't seen before. Obviously, both of us being in the real estate sector.
Yeah, it's pretty incredible. Obviously, the investors I talk to are pretty involved, right? I mean, it does give you the passive opportunity, but uh, you know, as someone who likes to know what's happening, and I'm sure most are the same way,
Right.
right? You can be involved as much or as little as you want.
Right.
So kind of explain now once it's passed on kind of the structure, right? So um, the idea is that you go out and you get business credit, right? And you use business credit, lever up, and then purchase these stores, right? So
Right.
ideally, there's no cash out of pocket. So I mean, technically speaking, it's almost an infinite return.
Yeah.
Uh, and then you guys, if I've understand, you guys stay on for 2 years, right? And technically, after 2 years, we have the opportunity to sell, or we can stay as well.
3 years, but yes.
3 years,
And
okay.
so we've restructured our management purchase contract agreement. So up to 3 years for now. It gives the client enough time to realize if they like us or not, and if they want to sell, they can. But if they want to continue cash flow, uh, they can. Ideally, it makes much more sense to stay on. The longer you stay on, the more brand equity appreciation you're gaining over time. Um, so yeah, this is a cash flow ploy, right? This is not a buy and hold and then exit in 3 to 5 years like in traditional multifamily. So, but yes, ideally you have two options, right? You can lever up using 0% APR credit cards, which is what a lot of my clients have used because they don't want to come out of pocket. And I do have other clients that have come on liquid. They just want to throw in 150, 200,000 into a business and see what happens. And also to comment on what you mentioned, right? A lot of my clients are very hands-on. They want to know what's going on. They want to be involved. It's usually like that within the first 90 days because most people don't understand this, which is okay. That's what I'm here for. But usually within the first 90 days, after then, once they consistently start seeing distributions, they relax, they dial down, and then they don't have to be as hands-on if they don't want to. I have other clients that are like, hey, here, go have fun and just make me a return. So it really just depends. But yeah.
Totally. I love it. And what is the primary focus in terms of what you're selling and, where you're selling and kind of some of those nuances?
So the business that a client is acquiring, like via an M&A transaction, it's a cash flow business, right? So our fiduciary duty as the management company, I guess if you want to analogize it to real estate, the gray star is, or Wood Partners or whatever, is to make sure that month over month these businesses are profitable and they're positive EBITDA. If not, we don't get paid. So we charge a performance fee structure based off of the equity waterfall. When we can go into that later. Now, the products that are being sold on these stores are evergreen products. So we don't sell stupid fidget spinners or weird little keychains that kind of fizzle out in demand within a couple of months. We sell products that have intrinsic demand baked into it, mixed in with counter cyclicals and some cyclicals. What I mean by that is whatever a consumer, like a pragmatic consumer, would need, right? So we only sell toiletries, feminine products, beauty supplies, apparel, fashion, consumer electronics, home goods, fitness goods, anything that a consumer would actually need, especially going into an environment like this that we're going into right now. Now, once we find a product that is generating a minimum 8.2x return of ad spend, then we'll build a store around it. So we'll scale the product around one product, and then we'll cycle in different counter cyclicals. Let's say we're selling a store that sells, I don't know, the target demographic is selling, or the target demographic is 25-year-old women plus in Norway that like to go skiing. So the product that we're going to sell to them is a coat, right? Okay, that's the main product that we're scaling the store around. Now we'll add in a beanie and some gloves or whatever that can actually serve as some counter cyclicals that serve as upsells whenever you're selling the product. So 70% of the revenue is going to go towards that one, or is going to go towards selling that one coat, and 30% is going to come from upsells. Now, whenever the product fizzles out in demand and dies out, because products do fizzle out in demand, usually the lifespan of a product is like 6 to 9 months, sometimes less, sometimes more. It really just depends on the seasonality component to it. Let's say it's spring and no one wants to buy coats anymore in Norway. The beauty of this is that since this is a very agile and versatile business structure and business plan, because it is e-commerce, we can pivot our investment thesis on a drop of a dime. So what we're doing to preserve capital month over month is we're constantly testing new products in the back end to make sure that once a product dips below 4 to 5x ROAS, return of ad spend, that alerts our in-house marketing agency and our ops team, who are commingled, they're intertwined, they basically operate simultaneously. If it dips below 4 or 5x, that alerts our marketing team to test the ad campaign. So we'll test the creative, the copy, to make sure that's not an ad problem. If it's not an ad problem, the product just died, no one wants to buy the coat anymore. Okay, we're constantly testing products in the back end. We can cycle in a new product that has a minimum 8.2x return of ad spend. So month over month, you never really see a dip in revenue, which is, I haven't seen that in many other business structures. And from a risk mitigation and capital preservation perspective, it is very hard to lose capital when done correctly, since you can pivot, which is the difference between this and traditional private equity.
Absolutely. And so let's kind of discuss logistics, right? Kind of the warehousing and how all of that works so that you can pivot, right? So you don't end up, buying 1,000 coats and there's only 500 orders. How does that category function?
That's a great question. So we've reverse engineered this before I go into that, I want to explain the difference between our model and the traditional e-commerce model in the United States. So I'm sure, Jonathan, you and probably like 95% of most people have heard of drop shipping. Drop shipping is probably the most saturated business model or business in the United States because it's a very low barrier to entry. With $5,000, you can launch a business online on Shopify or whatever, and you can test it out. Now, it is capital intensive and labor intensive. So if done correctly, you're going to need a lot more money to do this, which is why we're at the advantage. However, though, drop shipping, since it is very saturated and it's very competitive, and from a logistics standpoint, you don't really get a lot of pricing power. Actually, you don't get any pricing power, because the way it works is, from a consumer's perspective, when you see an ad to buy my keychain, you order it and then you pay for it and then it's shipped to your house. So the fulfillment works that once they pay for it, the order goes into a SKU and then it's fulfilled by the supplier. The supplier fulfills it, just orders one product and they ship it, right? And it just arrives to their house, kind of like Amazon. However, though, with what we do with the cash on delivery model, which is what not many people here in the United States are doing, that model is actually the preferred form of commerce in most European countries and in India. So I'm sure most people can extrapolate the meaning of what cash on delivery means. Essentially, if you want to analogize it to anything and simplify it, it's like the pizza delivery. You can order my keychain, but you don't have to pay for it until it physically arrives to your house. So you pay cash or card in person. That arbitrage we're capitalizing in Europe. Most people, that model does not work here, because the consumer behavior, the consumer propensities is people just want stuff shipped to their house. They want that convenience. The consumer behavior in most European countries, smaller ones like Italy, Spain, Malta, Portugal, Romania, is that they actually prefer to pay in person because there's a level of skepticism which is a little bit higher generally in the consumer and just in the overall public. Now, we've reverse engineered the logistics to avoid and to mitigate as much as possible excess inventory risk. What I mean by that is, so with cash and delivery, we have to buy in bulk. We have to warehouse these products. However, though, with traditional e-commerce or just traditional brick and mortar or brick and mortar businesses that use omni channels to sell products online, usually, let's say Costco or whatever, a big retailer, they'll buy 1,000 units of whatever, and then they'll try to sell 1,000 units. However, though, you're exposed at an elevated risk to excess inventory. What we've done is we reverse engineered it. So I don't want to say we wait because we don't really wait, but just to simplify it, we'll wait for 1,000 orders, and then we'll order 900 units, and we'll order 200 to 300 units, so micro quantities every 7 days. So we can ensure as much as possible that we're going to sell out those 200 to 300 units every 7 days. So we don't have that excess inventory risk. Now, since the customer's paying cash or card in person, our carriers from our 3PL partnerships that we use in these countries that I mentioned in Europe, the reason why we're in these countries is because that's where our manufacturing departments and plants are at, along with our 3PL suppliers and carriers. But since they're the receivers of the cash, it takes 14 days for the cash or the revenue to hit your Wise account. So that's how it works. That's the logistical side of it. Now, usually within the first 30 to 45 days, a lot of clients don't really understand how it works. They're seeing all these orders, but revenue is not being collected because there's that perpetual lag. So that's why it's most of my clients are very hands-on in the beginning because they don't understand it. But yeah, I guess that's I try to simplify it as much as possible. Maybe that was too much, but what do you think? Was that too much or thoughts?
I mean, the only way it'd be too much is obviously here in the US, like you mentioned, we don't use that structure. So it
Right.
is, I mean, the pizza analogy is a very, very good explanation. Why is it so prominent over there? And how did you identify that, to go over to those markets as opposed to, either try it here or jump on board with what works here?
Got it. So the cash and delivery model, I think it worked back in the 80s or 90s in California. That that's what I remember reading, doing my research about this a couple of years ago. But it ended up dying out. So in Europe, like I mentioned earlier, right, the general consumer behavior is that people tend to have a higher level of skepticism when buying any products online. So the overall saying of people keeping huge amounts of cash under their mattress, that's actually true in most, especially smaller European countries that are not as economically developed as the United States. Um, that is actually the preferred form of buying any form of goods, especially if it's delivered to their house. So the reason why we've identified this is because our operations team, our team that does our product research, development, and selection, they're actually based out of Italy. So they're in house with us, but when we first initiated the relationship, they were a third party. They're the ones that introduced us to all of our suppliers. They're the ones that identified this arbitrage that's not being capitalized. So, however, though, marketing strategies and marketing techniques in Europe are like 10 years behind when it comes to bringing on clients, lowering client acquisition costs, and just overall extending the lifetime value of a customer. It's just not as developed as it is here in the US. So the beauty of what we're doing is that we have our marketing in-house, but it's in the US. So we're capitalizing on US based business structure, business strategies in countries that are 10 years behind on bringing on clients when it comes to marketing and just digital marketing. So that's how we've I guess tried to monopolize this business as much as possible. We're still a long way to go. Um, I would say I would start with that to not overcomplicate anything, but that's how we've identified everything so far.
Yeah, it's pretty, and certainly, when you hear that, right? I mean, so many people, right? We think of Amazon, was it FBO, right?
FBA, but yes.
FBA. Uh and it's new, right? It's very new here. Not over there though, which is very, very interesting. What do you see that trend continuing? Are they eventually going to get on the same level we are, or do you kind of see that to continue to be the trend?
So the goal would be to expand continuously into countries that they're behind. So ideally, our goal is by the end of the year to get into India, because that is the only way they actually they do commerce. Also, we're trying to break into Brazil and Colombia, Chile. I have family in Chile, so I could potentially facilitate that entry into that country, and in Argentina. Here in the US, I don't know if that's going to work. Now, overall, when we're comparing this to Amazon, there's a lot of differences when it comes to actually owning a store. There's different macro and structural risks because you're a vendor on Amazon's platform. Now, that's a little bit different when you mentioned earlier about like if this trend of cash on delivery is going to continue. The beauty of this is that if things don't work, we can pivot. That's the difference between e-commerce and just traditional real estate private equity or venture capital. You're basically tied into an illiquid asset and you have to hope and pray that your underwriting assumptions was conservative enough, especially in a time of economic contraction. So when things don't work, and the reason why we've also positioned ourselves in Europe is we're in 9 countries in Europe. So we're in Portugal, Spain, Malta, Italy, Romania, Luxembourg, Norway, Finland, and Luxembourg. So the beauty of this is that when things don't work or when business strategies don't work in a certain country, the beauty is that we can literally pick up the business and move it to another country because we have supply chains positioned there. If cash and delivery does not work for whatever reason anymore in the future, the beauty is that we can pivot to a drop shipping model because we have the supply chains. The beauty is that we can also sell digital products, which your margins are amazing because there's no physical, products, there's no cost of goods. There's ways you can pivot your entire investment thesis within a drop of 72 to 96 hours, which is what you can't get in other business models.
Oh, very interesting. Very, very interesting. So obviously, it sounds incredible, right? Aside from the higher barrier to entry, what are some of the other risks potentially that you have, with this structure?
It's a good question. A lot of my initial clients that I brought on, especially recently, most of them are saying that this is too good to be true because it doesn't seem like there's any risk. There are a lot of risks, but as the management company, we assume and accrue all of them for the client. So to make this as much as a white glove service as possible. So I would say risks are during the first 30 to 60 days, your Facebook account or Instagram marketing account will probably get banned because with the capital partners influx of capital that they're contributing to the business, we're generating so much revenue that the Facebook algorithms probably think we're a robot. So we have to reinstate the business or reinstate the SKU or the pixel back in correctly because we most likely will get banned. It is very unlikely that your Shopify domain will get banned, but I've seen it happen. All of these hiccups about accounts getting banned, cards getting frozen, usually happens within the first 30 to 60 days. We take care of that for them and we get things reinstated as quickly as possible, usually within 36 to 72 hours. Once everything's ironed out and everything is fluid and smooth, then over time, there aren't that many hiccups. Now, when they do arise, kind of like traditional sponsors or syndicators when they're operating on a specific asset, they're the ones that obviously usually take care of any tax related issues that come up with the property or any dips in delinquency. It's the same with us. Whenever anything does happen, we take care of all of it. Now, if we're talking about huge macro structural issues that could happen that can affect the whole world economy, that's obviously out of all of our control, right? But there are some risks, right? Like let's say you're selling apparel in Italy, and Italy goes into a 3-month holiday and doesn't want to sell anything for whatever reason. Or let's say the country blows up. Knock on wood. Hope that doesn't happen. But if that's the case, that's the beauty of this, right? Like I mentioned earlier, we can pivot. So, and since there's no physical encumbrances, we can move the business to another country if we need to. Now, if the product dies out, we can switch out different products. If the whole niche and demographic within this certain mile radius dies out, we can move to a different mile radius or to a different geographical area that has within a different mile radius. Excuse me. So that's the beauty of this. That there are risks. Facebook could shut down forever. 3 billion users can't use Facebook anymore. How likely is that going to happen? Probably very unlikely. So the smaller micro, we take care of it. The macro is mostly out of all of our controls, but I don't really see the country of Finland blowing up anytime soon or there being an internet outage in Spain for 2 months. But yeah.
Totally. Yeah, I mean, makes perfect sense, right? It's important to cover all of that because, as we do head into this downturn, certainly that was kind of one of my biggest questions. And, you know, that could be a factor. But, if you look at it from a real estate standpoint, I mean, the short-term rental portfolio that I'm invested in is still off the chart bookings. In fact, just a couple weeks ago, we had our best week ever since inception, about a year ago. So when you kind of look at the macro trends, there are some things that are happening, but ultimately it doesn't feel like it's as big of a blanket kind of recession as we've been used to where s- almost that perfect storm, like you explained, where, metaphorically blows up to where the global economy shuts down for, months at a time. Now, certainly that is a factor and can happen, but like you mentioned,
Yeah.
out of our control, right? There's nothing we can do about that.
Yep.
So one thing I'm curious about when it comes to the products, what tier are they typically in, like low tier, mid tier, high in terms of quality? Are you trying to get the best quality, or are you just trying to get, kind of use the data available to see what specific product brand is being sold?
That's a good question. It's a mixture of top and medium tier. I've never been asked that question, but I that's a really good question. Yes, top and medium tier. Usually, medium tier is during the testing phase, just to validate the demand of the product, and then obviously, whenever we're ready to go into production and we're ready to go into scale, we order the best of the best from what our manufacturer can provide us, and then that's what we supply to our customers, and that's what we build the entire brand around. So, like I mentioned earlier, right? You're not really buying a brand over time. This is a cash flow business. Over since we can pivot products, now, over time, when people buy a product or order something on your website or your digital storefront, over time we are storing and seasoning the intellectual property. Right, we're gaining a huge list of emails and SMS, phone numbers, and first names and last names, and we're storing all that data within our algorithms. Well, it's your algorithms, right? Because you own the business. But we're storing all that info for you. So over time, the reason why I suggest my clients to not sell on year three is because it takes at least 5 to 7 years to scale a brand and do it correctly. That's the illiquid component of e-commerce because it just takes time to build a loyalty customer base and accrue a social media following on all platforms. But once we've done that, then and we build a branded product around it, that's how we can scale into a higher echelon. And obviously, we would be selling a much more higher tiered quality product by then.
I love it. And are these products being made specifically for these stores, or are there other stores, other like, anybody can go to this manufacturer and buy this product and sell it?
So we have that private relationship right now with our suppliers. So like I mentioned earlier, we have 99. Yeah, 99. Today we brought on another client. 99 businesses under management. Not one client out of the 99 is selling the same product in the same niche. Now, there might be some sort of a similarity between products. Let's say you're selling bathing suits in, I don't know, Sicily, and you're also selling a similar version of that bathing suit in Barcelona. If it's not going to be the same exact product. It would probably be a different color wave or color pattern, some different texture within the fabric. Nothing is exactly the same. Now, when it comes to anyone going online and finding these products like on AliExpress or Alibaba, no, we have that personable, intimate relationship with our manufacturers that as of right now, we are one of the few clients of theirs that get to use that have access to their products. And that's the beauty of using them and what is our advantage comparing to all the American e-commerce gurus out there. We're not susceptible to Chinese supply chain bottleneck risks because we don't use Chinese suppliers or manufacturers at all. They're all in-house within, like for example, in Italy, we have a manufacturing plant in Rome, Milan. We have one in Florence, and we have one in southern Italy near Napoli, and one in Malta as well. So it's just all local, which is great. We get to have a hands-on approach to everything.
That's awesome. So, pull out your muddy crystal ball here. What do you kind of see for the future? Obviously, e-commerce, right? Did some research. $9 trillion industry growing 12 to 14% year over year.
Yep.
So, e-commerce itself not going anywhere. It's not worried about that. What do you see kind of for the future SE portfolios and kind of trending forward? What plans do you have to continue to scale?
Yeah, so I would say two things. For SC Portfolios, we're actually rebranding to a new name called MG Portfolios. It's the last name of my two partners, which are the founding partners. Um, like I said, I'm not the founder. I raise capital. I'm one of the partners. But so the name of the company is going to be completely different because our goal long term is to turn this into a legitimized, securitized, and institutionalized financial product. Meaning that our goal is to take this and IPO this because fundamentally, from an underwriting perspective and from a return structure, you can get to economies of scale and you can get diluted. You can dilute your concentration risk. That's what I meant. You can diversify into different stores in different countries, selling different products. So fundamentally, it's very similar to real estate. So our goal is to turn this into an actual financial product that any financial advisor in a Northwestern Mutual in, I don't know, Omaha can suggest their clients to, hey, buy into acquiring 10% ownership in this tranched e-commerce portfolio on this stock exchange or on this S&P 500 stock or whatever. That's our goal to institutionalize this now, because right now e-commerce is not under the scrutiny of the SEC. It's not under their umbrella. So our goal is obviously to get under that and take this public. Now, once we get to about 150 stores under management, we will be raising only institutional capital, which is why we're rebranding our name to MG Portfolios because the initial I guess target demographic for our clients were more the aspiring non-accredited investor that is looking to actually become a sophisticated, savvy business person. Now, most of my clients are more professional. They've come from a private equity, venture capital, fund managing background. So we've had to restructure our entire marketing platform. So that's one thing. Now, for me personally, I'm actually starting an open-ended fund with a couple of my partners. I don't want to disclose their names right now. They're actually pretty well known in the real estate syndication space. Um, and the goal is to have multiple verticals, right? The majority of the cash on cash returns that you'll see in e-commerce, you probably won't see that in other vehicles. So our goal is for my fund is to have e-commerce as the foundation, along with a real estate vertical, so people can have collateral, so people can have, enjoy bonus depreciation and cost segregation. And I want another vertical. I want some sort of a private credit, investment grade credit vertical, because right now in private equity, there's a lack of funding because the cost of capital being so high. So that's all going to be within one fund. And the goal is to serve as a JV equity partner for MG portfolios moving forward. So there's a lot of things that we're working out right now. We're actually starting on a debt fund that should be rolled out in the next 60 days. We're partnering with a big private equity firm out of Virginia. I don't know if I'm at liberty to say their name right now, but the goal would be to provide financing for people that don't have access to credit, or for whatever reason they just can't get credit. Would be able to supply some sort of a financing material, because banks, there's no way they're going to lend on this. Their underwriting models are so archaic. I think, to my knowledge, I don't think banks even lend on Airbnb, certain Airbnbs right now. Airbnb has been around for like 8, 9, 10 years. So banks are very archaic. They're really pretty late to the game. So we're trying to, I guess, bridge that demographic of people that can't get access to financing. And we're also starting there's a lot of things we're doing. I don't want to go too much into the nitty gritty, but debt fund, my own open-ended fund, rebranding, and turning this into a financial product. So there's a lot of things. We're working a lot.
Absolutely. I love it.
Yeah.
That's incredible. A lot of big things coming, obviously, and very stoked to be a part of it. And, obviously, as any good fund manager does, investing in it first, then eventually, same thing, goal would be to bring a fund, bring other investors, get them on board as well, because clearly there's something here, right? And it's growing and it's not going anywhere, like we mentioned, right? $9 trillion industry that's growing, 10-12% year over year. So it'll certainly be a wild ride to be a part of and kind of see how it grows. So I love it. Cool. Well, let's go ahead and wind down. We'll jump to the final five here, Ben. First question: best advice you've gotten from a mentor?
I guess I would say I give as much as you can for free, and everything will come back in abundance. So never really ask for anything in return, because things will actually come back to you without asking. That's what
Totally.
I'd say is one.
I love it. Absolutely. What is about your career that makes you feel like you're fulfilling your why?
Oh my goodness, that's a great question. I'm 24 years old. I should be retiring my mom by the time. By the time I'm still 24, so she should be retired by December or January. December this year, January next year. That is a dream that I never thought I would have ever realized, working as an employee within an operating company. So that's my short-term why. My long-term why would probably be to help. I believe every person deserves to have access to some sort of a passive vehicle where they can make extra money. I would like to help doctors as well because my biological dad, he's a doctor. He's not around, so I definitely understand the hardships of families that have doctors and that work ridiculous hours. So just helping people get retired and spend more time with their family.
That's awesome. I love it. Favorite non-real estate or investment related book?
Oof. Non-real estate. Okay. There's one called Fundraising by Ryan Breslow. I guess it's still business, but it's not real estate. Rich Dad Poor Dad, kind of like everyone else. There's a couple more. Blue Ocean Strategy. That's a really good one. I have this one right here, actually. Blue Ocean Strategy by, you never pronounce their last name. Chan Kim. Oh, the other last name. There's two authors. But this is a great book if anyone's interested in that one. Yeah, let's start with those.
I love it. Yeah. Just put fundraising on the list. Blue Ocean, I've gotten before. Great book. A lot of recommendations.
Yep.
If you could have any superpower, what would it be?
I would say being able to talk slower. I talk way too fast. I get it all the time. Come on, Ben. You need to slow down. I'm like, I'm trying. I just got so much I want to say. So that'd be my superpower.
I love it. That's funny. Cool. Last one. What's the best way for people to get a hold of you and learn more?
So LinkedIn, Benjamin Cohen is my first name. Find me on there. My profile picture, I look like I'm 15. So you guys should be able to see me. My email address, bcbequity@gmail.com. So B as in boy, C, B again, equity. And yeah, I'll start with that.
I love it. Yeah, when he first reached out to me on LinkedIn, I thought he was reaching out as like a business development rep for QC Capital. I was like, "Hey man, I know your CEO personally." He's like, "Oh yeah, no, this has nothing to do with Chris." And I was like, "Okay, cool." Yeah, that's pretty funny. Cool. Well, Ben, thank you so much for your time. This is absolutely amazing. Appreciate it.
Sweet, man. I appreciate it. Thank you.
Absolutely. Thank you again for tuning in. Who do you know that wants more cash flow? Share this episode with them so you can grow your cash flow together. If you enjoyed the show, make sure you're subscribed on your platform of choice so you never miss a new episode. Go to CataniCapitalGroup.com to learn more.